Most traders don't lose because the market is unfair. They lose because their stop loss tells the composite operator exactly where to strike. Richard Wyckoff would warn that nothing reveals a trader's inexperience more than a poorly placed stop. Imagine this: price drifts into a well-defined support zone, volume is drying up, and the chart whispers accumulation. Yet 90% of retail traders stack their stops in the same obvious pocket. The composite operator sees this cluster the way a hunter sees footsteps in fresh snow. A sudden shakeout candle sweeps the level, triggers every clustered stop, and instantly reverses, leaving uninformed traders stunned and empty-handed. This single moment captures all 5 fatal stop-loss mistakes Wyckoff cautioned against: misreading the tape, placing stops where the crowd hides, ignoring the true trend, reacting emotionally, and letting the market shake them out right before the move. Ladies and gentlemen, traders and students of the market, tonight we confront one of the most misunderstood tools in speculation, the stop-loss. Richard Wyckoff taught that losses are not merely financial setbacks. They are messages written by the composite operator, clues revealing where the uninformed crowd is trapped. And yet, despite a century of wisdom, traders continue to place stops in the very locations where the market is engineered to shake them out. In this talk, we will dissect the 5 fatal stop-loss mistakes Wyckoff warned against, errors that silently drain accounts, sabotage discipline, and hand profits to stronger hands. My goal is simple: by the end of this speech, you will not only understand where to place a stop, but why the market tries so hard to hunt it. Let us step into Wyckoff's world, where every candle has intention, every wick has meaning, and every stop-loss, properly placed, becomes a shield instead of a trap. Proper stop-loss placement, in the spirit of Richard Wyckoff, is not simply a mechanical act. It is an intimate reading of market intentions. Wyckoff believed the market is a story, written in price and volume, and every stop-loss a trader places must align with the chapter that story is currently telling. In other words, a stop-loss is not a random number of points away from entry. It is a strategic location chosen to protect capital without sacrificing logical market structure. Yet most traders commit the fatal error of placing stops at arbitrary distances, relying on rigid formulas like 20 pips or 2%, without considering the path the composite operator's CCO is tracing through the chart. These traders assume the market will adapt to their rule. Wyckoff taught the opposite. You must adapt to the market. True stop-loss placement begins with understanding where the composite operator is likely active. Wyckoff repeatedly emphasized that the CO accumulates and distributes in areas where the public is uncertain. This uncertainty creates the perfect environment for shakeouts and upthrusts, moves specifically engineered to trigger poorly placed stops. A stop-loss sitting just below support or just above resistance is an invitation for the market to test the level. The test, fueled by lower volume and designed to probe for supply or demand, often sweeps out traders whose stops are too tight or placed in predictable zones. Wyckoff would argue that the error is not in using stops, but in using stops without understanding market behavior. The professional trader places stops where the logic breaks, not where the crowd hides. If you are long, your stop should sit below the level that, once broken, signals the composite operator is no longer supporting the move. Similarly, if you are short, the stop must rest above the level that invalidates the supply narrative. This approach keeps the trader aligned with the genuine law of cause, an effect that Wyckoff emphasized. The best stop-loss is invisible to the public but visible to your analysis, hidden behind structure, beneath tests, beyond shakeouts, and outside areas where amateurs cluster their orders. Wyckoff also taught that stop-loss placement must reflect the phase of the market. During accumulation, volatility is higher and sudden shakeouts are common. Thus, stops must be wider and placed outside the danger zone During markup, structure becomes clearer, trends more defined, and stops can tighten as price moves in harmony with demand. In distribution, the market often becomes choppy and deceptive. False breakouts and bull traps are frequent. Here, a tight stop may be warranted, but only if it respects the dominant supply signature. Adjusting stops based on the phase of the cycle is essential not only for safety but also for staying aligned with institutional behavior. Ultimately, Wyckoff's perspective on stop-loss placement can be summarized in one principle: a stop represents the point at which the market proves your idea wrong. Anything else is noise. When traders place stops logically rather than emotionally, they protect not just their capital but their confidence, and confidence in trading is priceless. Understanding composite operator psychology is the core of Wyckoff's entire trading methodology. To Wyckoff, the market was not a chaotic battlefield. It was a carefully orchestrated campaign led by a single intelligent force, the composite operator's SEO. This operator represents the collective actions of smart money, large institutions, banks, syndicates, and professionals who trade with size and purpose. When traders learn to interpret price and volume as the footsteps of this operator, stop-loss placement, entries, and exits suddenly become clearer and more precise. But most traders never make this shift. They see candles. Wyckoff saw intentions. The psychology of the composite operator begins with one truth: the CO must accumulate without raising prices and distribute without lowering them. This requires patience, tactics, and manipulation, not in a malicious sense, but in a professional one. When you have millions to deploy, you cannot simply buy now. You must coax the public into selling. And when you wish to unload at the top, you must convince the public that the uptrend is still healthy. This is where stop-loss hunting, shakeouts, and upthrusts become tools, not to punish traders, but to create liquidity. Wyckoff explained that the CO is a master of testing. When price approaches a support level during accumulation, the composite operator wants to know, is there still supply here? Are weak hands still hanging on? Are stops clustered below this level? A quick shakeout answers all these questions at once. The stop losses triggered in this moment become fuel. The downward spike gives the CO cheap shares. When price instantly springs back, it signals demand is dominant and accumulation continues. This is not random volatility. It is deliberate probing, crafted to reveal who is committed and who is fearful. Similarly, during distribution, the composite operator uses the opposite psychology. Instead of forcing price downward, they nudge it upward above resistance, triggering breakout traders and stop losses of early short sellers. This upthrust gives the appearance of strength, but the CO uses it to unload positions onto unsuspecting traders. Once the public is trapped, the true markdown begins. Again, the psychology is the same: test, trap, absorb liquidity, and advance the campaign. What most retail traders misunderstand is that the composite operator is not hunting your stop-loss personally. The CO is hunting liquidity, and because most traders think alike, fear alike, and place stop-losses alike, their orders naturally pool in the same obvious zones. Wyckoff repeatedly warned that the average trader reveals his position through predictable behavior, and predictable behavior is exploitable behavior. To align with CO psychology, a trader must stop reacting emotionally and start observing behavior. When price dips below a known level on low volume, that is not bearish, it is a test. When price rallies above resistance on weakening volume, that is not strength, it is a trap. When the market moves violently just before a major trend begins, that is not manipulation. It is preparation. Once you grasp the composite operator's incentives, the market stops looking like a dangerous battlefield and begins to look like a perfectly logical narrative. You no longer panic when your stop-loss survives by a few points. You understand why the market probed that level. You no longer enter breakouts blindly. You look at volume to see whether the CO supports the move. This psychological shift transforms confusion into clarity and fear into discipline. If you can think like the composite operator, you can finally trade with him, not against him. One of the most costly errors Wyckoff observed among traders, especially those new to tape reading, is the chronic misreading of market structure. To Wyckoff, market structure was not just support and resistance, it was the architecture of intent, the visible skeleton of the composite operator's campaign. When traders fail to understand this structure, they place stop losses in dangerous zones, misinterpret normal testing as reversal, and confuse manipulation for momentum. Misreading structure is not a small mistake. It is the silent destroyer of accounts. Market structure in Wyckoff's teaching is built around phases: accumulation, markup, distribution, and markdown. Each phase has its own rhythm, volatility, tests, and characteristic footprints on the chart, but retail traders often see all phases as the same. They interpret a spring in accumulation as a bearish breakdown. They treat a distribution upthrust as a bullish breakout. They place stops just beneath support in accumulation, unaware that this is precisely where a spring is supposed to occur. As a result, they are ejected from trades moments before the composite operator reveals his true intention. The most common misread happens during accumulation. The market will move sideways, seemingly without direction, and traders mistake this for weakness. When price dips sharply below the range, especially on low to moderate volume, they panic, believing the trend has turned bearish. In reality, the composite operator is performing a test, searching for remaining supply. If traders understood this structure, they would recognize the spring as bullish, not bearish. But because they misread it, they place stops just under the support zone and feed liquidity directly to the CO. In distribution, the opposite mistake occurs. Here, the structure is designed to fool traders into believing the trend is continuing upward. Small pushes above resistance, upthrusts, are meant to create excitement. The public sees breakout opportunities while the CO quietly unloads massive positions onto them. Retail traders misread the upthrust as strength instead of exhaustion. They buy the top, place stops right under the breakout level, and get trapped when the true markdown begins. Another major misreading comes from not understanding trend logic. Wyckoff insisted that traders must observe higher highs, higher lows, lower highs, and lower lows, not as simple patterns, but as expressions of supply and demand shifts. When a trend is healthy, reactions are normal. When reactions deepen, its signals change. But most traders treat every pullback as the end of the trend and every rally as a breakout. They forget Wyckoff's rule: effort must equal result. If volume spikes but price moves little, the trend is weakening. If price runs easily on modest volume, the trend is strong. Misreading this dynamic leads to premature exits, unnecessary stop-outs, and emotional decision-making. One of the deadliest consequences of misreading structure is placing stops where structure appears logical, instead of where logic is proven. For example, placing a stop right below the last swing low is logical, but also predictable. The composite operator knows this area will be tested. A smart stop must be placed beyond the test, not inside it. Proper market structure reading allows you to see where tests are likely, where traps occur, and where the CO is absorbing orders. In the end, Wyckoff's message is clear: you don't trade the market. You trade its structure. And if you cannot read that structure, you will always be early, always be late, or always be wrong. Understanding structure is the key to placing stops where the market won't go and entries where the CO must go. Richard Wyckoff repeatedly emphasized that the greatest danger in trading is not the market. It is the trader's own emotional reactions to the market. Emotional exits, especially those driven by fear, impatience, and uncertainty, are the silent killers of trading consistency. While a stop loss is designed to protect capital, An emotionally triggered exit often destroys both capital and confidence. Wyckoff believed that the market is a mirror, reflecting a trader's psychological weaknesses long before it reflects their technical ones. And when a trader responds emotionally, he becomes easy prey for the composite operator. The most common emotional exit trigger is fear of temporary adverse movement. A trader enters a position and price moves slightly against him. Even though the move is normal, part of structure, a test, or a reaction, panic sets in. Instead of letting the market breathe, the trader manually exits, only to watch price reverse in his original direction. Wyckoff explained that this fear arises from a lack of understanding of the market's natural rhythm. Every trend contains pullbacks. Every range contains tests. Every accumulation contains shakeouts. These movements are not threats. They are necessary steps in the composite operator's larger campaign. But when a trader interprets every dip as danger, he exits emotionally instead of logically. Another powerful emotional trigger is the fear of missing out, FOMO. When price begins moving rapidly after a period of consolidation, traders jump in late, entering at points where the composite operator is actually unloading positions. Because their entry is poor, their stop must sit uncomfortably close. The market then performs a routine test, and the trader, already insecure because of the late entry, closes the trade manually, interpreting normal behavior as a threat. Wyckoff noted that a poor entry almost always produces an emotional exit because the trader knows, deep down, that he is trading out of impulse rather than method. Wyckoff also identified hope as a destructive emotion in exits. Hope causes traders to delay taking a loss even when their stop loss is logically justified. Instead of exiting at a planned level where the idea is invalidated, the trader hopes the market will turn in his favor. He widens his stop, or worse, removes it entirely, allowing a small, manageable loss to turn into a catastrophic one. Wyckoff called this wishful thinking, the enemy of every professional. Hope has no place in trading because it blinds the trader to the true message of price and volume. When the market proves the idea wrong, the professional exits, the amateur hopes. Another emotional trigger is revenge trading, which Wyckoff described indirectly through the concept of emotionalized speculation. After taking a loss, traders feel the urge to win it back quickly. They rush into new trades, tighten stops out of fear, or widen stops out of desperation. These impulsive decisions lead to more losses. The composite operator, meanwhile, continues his campaign unaffected, while the trader spirals into emotional instability. Wyckoff's antidote to emotional exits was simple, but profound: trust the structure, trust the stop, trust the plan. If you have placed your stop based on logic rather than fear, you must allow the market to reach it or justify holding. Emotional exits violate the essence of disciplined trading because they prioritize short-term comfort over long-term consistency. Wyckoff taught that a trader must think and act like the composite operator: calm, deliberate, strategic. Emotional exit triggers do the opposite. They make the trader behave like the crowd. And once you think like the crowd, you lose like the crowd. The path to mastery is emotional neutrality, responding to the market, not reacting to it. Wyckoff risk management is far more than calculating position size or setting a stop loss. It is a philosophy of survival, a disciplined framework built around understanding the relationship between cause and effect, effort and result, probability and protection. Richard Wyckoff believed that successful speculation was not about predicting the market, but about managing exposure to the market's uncertainties. For him, risk management was not a defensive tool, it was the foundation upon which professional trading is built. Wyckoff's first principle of risk management is trading with a definable logic. Every trade must have a clear structural basis, a phase, a test, a spring, an upthrust, a breakout with confirmation, or a reaction showing diminishing supply. Without a logical structural reason, a trade is not speculation, It is gambling, and gambling has no place in Wyckoff's world. When you base entries on structure, your stop-loss becomes logical. It sits at the point where the structure is invalidated, not at an arbitrary number of pips or points. This alignment between analysis and risk is what gives Wyckoff traders confidence even when the market moves temporarily against them. Another cornerstone of Wyckoff's risk principles is the law of effort and result. If the market is showing large volumes effort but small progress result, something is wrong. This is often a warning to reduce risk or avoid entering altogether. Conversely, when the market moves smoothly on modest volume, showing harmony between effort and result, the risk of entering is lower. Wyckoff insisted that understanding these subtle signs helps traders avoid dangerous environments where volatility is manufactured to trap the uninformed. Position sizing also plays a vital role in Wyckoff's approach to risk. Instead of sizing positions emotionally or aggressively, he advocated sizing based on meaningful stop placement. If the logical stop is far away because the structure demands a wider margin, such as in broad accumulation zones, the trader should size smaller. If the structure allows a tight but logical stop, such as in a trending environment, size can increase. This dynamic adjustment keeps the trader aligned with market behavior rather than personal preference. One of Wyckoff's most overlooked risk management insights is the importance of avoiding trades during unclear phases. He taught that the composite operator reveals intentions gradually. When structure is unclear, when supply and demand are balanced, range boundaries are messy, volume is inconsistent, the risk rises dramatically. Wyckoff emphasized that no action is often the most powerful form of risk management. Professionals wait for clarity, amateurs force trades. Another crucial element is managing psychological risk. Wyckoff understood that emotional fragility leads to inconsistent decisions. A trader who risks too much becomes fearful. A fearful trader exits early, widens stops, hesitates to enter, or chases moves. All forms of psychological risk that erode performance. By risking only what can be comfortably tolerated, traders maintain mental stability, which prevents emotional trading. In Wyckoff's philosophy, emotional stability is risk management. Wyckoff also stressed the importance of reducing risk after profits. Once a trade begins working and price confirms the intended direction, stops can be trailed logically behind structure, behind higher lows in markup, lower highs in markdown, or behind successful tests. This approach locks in profits while letting the trend continue without premature exits. Ultimately, Wyckoff risk management is about aligning yourself with the composite operator while protecting yourself from the traps laid for the public. It ensures that no single trade can harm you and that every trade has a structural justification. It transforms trading from a chaotic emotional experience into a disciplined, repeatable process. In the Wyckoff framework, risk management is not optional. It is the difference between survival and destruction, between speculation and mastery. Ladies and gentlemen, the essence of Richard Wyckoff's teachings comes down to one truth: the market is not your enemy. Your misunderstanding of it is. Every stop-loss mistake, every emotional exit, every misread structure, every instance of fear or hesitation stems from failing to see the market through the eyes of the composite operator. Wyckoff spent his life showing traders that the market leaves clues, footprints, intentions, visible to anyone who learns to read them with discipline and clarity. When you place your stops logically rather than emotionally, when you understand the psychology of the composite operator, when you read structure instead of reacting to noise, and when you manage risk as a professional instead of a gambler, you separate yourself from the crowd Wyckoff warned about. You stop becoming the liquidity the market feeds on, and you start becoming the trader who moves with the flow of smart money. The 5 fatal stop-loss mistakes we explored are not just technical errors. They are psychological traps designed to remove the uninformed. But with Wyckoff's principles as your foundation, you can rise above these traps. You can place stops where intention is invalidated, not where fear whispers. You can wait for confirmation instead of chasing motion. You can protect your capital with logic instead of emotion, as Wyckoff taught. The market is a never-ending auction of human behavior. Your success depends on whether you behave like the crowd or like the operator. If you embrace these lessons, stop, loss placement, composite operator psychology, precise market structure reading, emotional control, and true Wyckoff-style risk management, you will no longer trade in darkness. You will trade with purpose, with clarity, and with the confidence of someone who finally understands how the market truly operates. Master these concepts, and you won't just survive the market. You'll read it, anticipate it, and thrive within it. That is the legacy Wyckoff left for every serious trader willing to study with intention.